Hi everyone, I'm Devin Coombs, CPA, and today I'm going to go over the two basic rules of accounting: debits equal credits and assets equal liabilities plus equity. Specifically, I'm going to cover the second piece there, the assets equal liabilities plus equity, but I need you to watch the previous video so you really understand this content. So know that these two rules of accounting never change. If you make sure these equations tie out, you're generally going to be right or in the right direction. If your assets don't equal liabilities plus equity, or your debits don't equal credits, you're going to have a bad time. Something's going wrong. So let's look at this. This is called the accounting equation. Just assets equal liabilities plus equity. Memorize that. Memorize the different forms. We can play with this formula, right? We can say assets minus equity equals liabilities, or assets minus liabilities equals equity. You can play with this algebraically. This equation is also known as the balance sheet. It's presented as the balance sheet on the financial statements. So let's just go over what are assets. Assets are resources owned or controlled by the company. They equal liabilities, the creditor's claims to those assets, or equity, plus equity, the owner's claims to those assets. So what we're really saying here is what you have, your assets, is equal to what you owe and what you own. And that makes sense, right? If I'm going to buy a house, right, I can put some of my own money into it, that's the equity, and I borrow some money from the bank, that's the liabilities. If a business starts and I have partners, all of my partner's money and my money is the equity, but if we borrow money from the bank in order to fund our business, that's our liabilities. And what do we purchase with these two things? How we finance our business? We purchase assets. Our assets, we use those assets in order to run the operations of our business and to generate cash. That's it. It's really simple. And once we know this basic function, we can really understand the underlying accounts that relate to each of these classes: assets, liabilities, and equity. So, like I said, you can finance your business really through investment from your partners. Number two, down here. Number three, borrowing money, which is liabilities. You can borrow it from the bank, you can borrow it from investors. And then number one, through your operations, which is known as retained earnings. And you're going to see this reflected in our accounting equation. So let's walk through each group: assets, liabilities, and equity, and then some of the common accounts there. So for assets, we have cash. Cash is something we can use to generate more cash and build our business. It's an asset. Accounts receivable, supplies, inventory, notes receivable, and plant, property, and equipment. And some of these are short-term assets and some of these are long-term, which we're going to go into in future detail in future courses. This equals our liabilities, which are just going to be debts owed, right? What's owed to creditors. This can be accounts payable. Accounts payable, we're really talking about money that we owe to fund our short-term business, generally with our vendors, right? Wages payable, money we owe to our employees. Taxes payable, what we owe to the government. And then notes payable are generally going to be those bank loans. That's it, right? So liabilities are what we owe to our creditors. Assets are what we own. Assets, again, pretty straightforward, right? Inventory, notes receivable, money that's owed to us. Plant, property, and equipment, that's long-term buildings, land, and equipment that we have. And accounts receivable is money that our customers owe us. And lastly, we have our equity. We have common stock. That's money that, if we have a corporation, money that investors have put into the business, which would then be part of our cash, right? See how these all tie? So there's going to be two sides. Anytime you have a transaction, accounting is just looking at transactions, you're going to affect two sides of the equation, or one side of the equation twice. We're going to go into that in our journal entries in the next few videos. And so we have common stock, preferred stock. Preferred stock is more of it's still from investors. It's still a way to finance a company, but it has certain rights, which we're going to talk about in our equity section. We have dividends. That's payments from the company to the investors. So you can pay wages to your investors and your employees, but you can also pay dividends to your investors. And so dividends is included in our equity, but it decreases our equity because we're losing equity by paying it to our investors. We have retained earnings, which again is just our cumulative net income or net loss, which would then be cumulative loss. It's just that cumulative running balance of how much we've made as a business after expenses and dividends. And so here's a formula just to memorize to help you make sense of this. Revenue minus our expenses. Anything in red is going to decrease that equity. So dividends and expenses. So revenue minus expenses equals net income. And this net income flows into our retained earnings, which we just track on for the company. This revenue minus expenses, this is known as the income statement. So right in this short video, right, we already know the balance sheet is the accounting equation, and just revenue minus our expenses is our income statement. Obviously, it's going to be a little more complex than that, but from a simplified version, if you know that, you're going to really do well starting off in your accounting education. So let's go over a quick problem that you might see related to the accounting equation. So at the end of 2020, a company has $50,000 in assets, $30,000 in liabilities, and $10,000 in common stock. The company issued $5,000 in dividends and had no retained earnings at the beginning of the period. What was the company's income or loss for the period? And then we have assortment of answers. And always these answers are going to try to trick you, right? There's going to be different ways to calculate each one of these. But all we have to do is go back to the accounting equation. And so I'll walk you through how I would approach the problem. So we know our assets were $50,000 if we go back. Our liabilities were $30,000. And then we had a little more detail with our equity. Our equity was $10,000 common stock and $5,000 dividends, but we know dividends decreases our equity balance. And then we had no retained earnings. So I'll just sum these up because assets should always equal liabilities plus equity. So we know our assets equal $50,000, our liabilities plus equity equal $35,000. That $30,000 plus the $10,000 minus the $5,000 equals our $35,000. So this difference has to be our income, which is going to flow into our retained earnings, right? That income balances this equation. And so our answer here is just going to be C, $15,000 in income. I hope I was able to make this easy for you. If you have any questions, comments, concerns, or anything that you think would help other students, feel free to add it to the comments section below. Please subscribe to this channel if you enjoyed this. I'll be sending out more videos over the upcoming weeks as I build out my Accounting 101 course for my college. So really looking forward to having you with us, and have a great day. Bye.